Good morning, Tim.
Good morning, James. Good to be here.
So thank you very much for doing this. I think we did have you on a couple of years ago, maybe something like that.
Something like
But
that, yeah.
yeah, and it's definitely worth, if you don't mind, just sort of introducing the fund again and why fintech, please.
Very happy to. So maybe what I'll do, James, is just try and give an accelerated summary of where the market has come from. I think people read a lot about fintech, and there's not always clarity as to where we are in the journey in terms of maturity. So I'll try and kind of give a sense of the journey that we've been on, but also the market has been on over the past 5 years or so, and then talk a little bit specifically about the fund, some of the portfolio, and the progress that we've made, and we'll try and do that in 10 minutes. So you can see here on the screen, and I'm not trying to become an economic or markets commentator, but I think what is interesting about this is what's been happening in the global listed space. Now, we are a closed-ended fintech-focused investment trust that solely invests in private fintech assets. So we are not focused on public listed fintech. But I think when you look at the perceived recovery in 2023 in particular, in terms of what happened in the NASDAQ, there has been an assumption that has flowed through to the listed fintech stocks. And this is an aggregated picture of about 100 global listed fintech stocks. And actually, you can see it really hasn't recovered at all. And there has been a real lag relative to the NASDAQ, which, as we all know, has been driven predominantly by the big seven. And when you strip that out, it's a very different picture. And so for those that are following the sector, not just in the private markets, but in the public markets as well, I think it's a really interesting period to watch those companies that start to break out from a listed point of view in terms of performance. And, you know, it's our expectation that we will see a real separation of, you know, those that are laggards, but also some that really start to do breakthrough in a very positive way. And I think in the UK markets, you've seen that over the last few months with Wise in the UK, which has traded particularly well. James, if you just move to the next slide, which really shows you what happened in what I would regard as the wild times of 21, largely the second half of 20, the full year of 21 and the first quarter of 2022, where we had how I would somewhat unfairly describe as a fire hose of tourist capital that came into the sector. And I think in an era of ZIRP, where we saw a huge number of investors come in for the first time looking for exposure at any cost to one of the most exciting emerging sectors that they believed. And I think what they got right was that there was a significant macro opportunity, structural opportunity over the following decade in financial services and the continued digitization and disruption. However, what we saw was too much money coming in at the wrong price, in not always in the wrong companies, but giving too much money to the right companies at the wrong headline price. And that really did distort the market. And it created a significant challenge for thesis-led investors such as ourselves, who have deep domain expertise, but fundamentals, frankly, flew out of the door. I think the good news is we've seen a significant correction over the past 12 months, and you can see that in that global fintech financing, which has reverted back to where we were in 2018, 2019, which, you know, in themselves, 2018 was a record year. And you can see the same thing in terms of the average fintech financing as well, where you see this massive spike. And what's really important to recognize, you know, our focus is where we would define where we add the most value and where we can deliver the greatest returns is at the Series A. So business is up and running, it's generating revenue, but we're often the first institutional capital that will come in. But we saw the market really inflate at the Series B and the Series C, the later stage, the growth capital stage. And that was because that was where these crossover funds, these hedge funds, sovereign wealth funds could get more money in the door. They contested that venture capital didn't scale, wasn't ambitious enough, they could hack the growth by putting tens of billions into the market collectively on a global scale and get to an accelerated growth far quicker. And the reality is that it takes time, it takes domain expertise, and we have seen that money eviscerate, which we think is a positive thing. So you have seen the market from an average funding round size point of view revert back to where we were in kind of 2018 and 2019, and we expect those conditions to carry on in 24. So just James, you just moved to 5. We see a lot of emerging technologies come through, not just in fintech, but in tech generally. And I think it's really important to kind of understand the evolution of some of these kind of emerging technologies. And I think a really good way of portraying it is, if you've not seen it before, the Gartner hype cycle. And if you flick to 6, James, you'll see what we've tried to do here, give you a sense of some of the subsectors within fintech that we have applied to this cycle. And I think from our point of view as an investor, it's really important for us not just to be right, but to be right at the right time. And I think there is always a danger that you come at the top of the peak, you pay an inflated price, you then start to see some of that potential not being fulfilled, and you move into this trust of disillusionment. But ultimately, we do have strong conviction across many of these subsector trends and propositions, but it is really important that we get our timing right as well. And we see that a lot in financial services. Yes, there is often a problem that needs to be solved, but it is often the case that the market isn't looking for that problem to be solved at that particular time. I think it's fair to say you shouldn't be surprised to see generative AI at the top of what we think is the peak. What is our view on AI? It's hugely exciting and concerning in equal measures, but they will present significant opportunities across financial services. At the same time, some of the entry valuations that we have seen in what we regard as kind of unproven propositions are hugely significant, in some cases hugely inflated. And so the challenge for us is to make sure we understand what's coming down the pipe, not get swept up in any of the hype, and really deal kind of with substance. So we'd be tracking near 40 to 50 innovative AI propositions that cross over with fintech, but we're very much operating on a watching brief. And at the same time, if we look at those propositions that have gone through the hype cycle, and I guess one of the higher profile areas is the challenger banks, which came under a huge amount of criticism 4 or 5 years ago when they were receiving very significant amounts of capital to build significant customer bases. The cost of acquisition was high. And I think now, having gone through the past 12 to 18 months of higher interest rate environments, obviously kind of increasing inflation, we've started to really see who will be the long-term winners. Those that have built out those significant customer bases, those that have built propositions that frankly have remained quite sticky to customers with a product set that has proven to be compelling to those customer bases, are starting for the first time to generate not only very significant revenues, but also showing the signs of some very significant profits alongside strong underlying growth metrics as well. So the likes of Tide in the SME banking space, where we're a shareholder, but also the likes of Monzo and Revolut and Starling have really kind of cut through with multi-million numbers of customers and moving to profitability, and in some cases quite considerable profitability as well. So I think you have to kind of take some of the hype, some of the noise in the market with a pinch of salt, but what you can't ignore is the longer term structural market opportunity, which is really important to reflect on. So James, if you move to 7, for investors, for me, the most straightforward argument and rationale as to why we believe investors must have diversified exposure to fintech is what's coming down the pipe over the next 5 to 10 years. And I think we all know how significant the market opportunity is in terms of market size. So we're talking about a $14–15 trillion global revenue opportunity. So huge market with really healthy margins as well. And we see those margins with lots of potential to be trimmed and eroded by efficiencies over the coming years. At the same time, I think the stat that surprises most prospective investors in Augmentum is how little the overall market has been disrupted by innovators to date. I think if we can point to a number of other sectors, they've been significantly disrupted, 10, 15, 20, 25% market share from innovators. But financial services has been a really slow market to disrupt. And there have been lots of good reasons for that. But if you think about the real catalyst for change post-financial crisis, which is now some 15, 16 years ago, it's pretty extraordinary that we sit here today at the beginning of 24, probably with a market around 300 billion of global revenues by fintechs, which is about 3–3.5% market share. So there is a long way to go. There is a significant amount of opportunities. You can see kind of the estimated CAGR of how we think that's going to grow. But between now and over the next 5 to 6 years, it's a market that will grow to about $1.5 trillion in global revenue. And that will still only represent sub 10% in terms of the overall market. So there are hundreds of very valuable multi-billion-dollar businesses that are going to be built over the next 5 or 6 years. It's our job as a domain expert to identify a handful of them and get in early enough where we can deliver that outsized return. So on to the next slide, and a real summary of what have the incumbents, traditional financial services players, have been doing. Well, what they have been doing over the past 20 years is investing enormous amounts of capital into R&D from their own balance sheet. And I think it's fair to say 15, 20 years on, that despite the trillions of dollars collectively that has been invested in their collective digital transformation, the vast majority of that capital has been deployed, invested pretty ineffectively. And it shouldn't come as any surprise that in many cases, these are hugely complex global organizations that are riddled with bureaucracy and efficiencies, sitting on legacy technology stacks. And it isn't a matter of throwing money at the problem. These have deep-seated structural challenges, and you can see we have a number of examples here, some of which in our portfolio, where these large incumbents have started to use their balance sheets to be more acquisitive, and we would expect that to continue not only over the next year, but over the next 5 to 10 years as well. If you look at every fintech that has been acquired over the past decade, 95% of those exits have come through M&A, either through PE or more common would be through strategics. Actually, a very small percentage go through to IPOs. And we often talk about the importance of an exit market, a buoyant IPO market. It actually isn't really the case. And I think that's a really important factor, an attractive factor for fintechs, where there is a very large pool of potential buyers that are having significant challenges with their own digital transformation. And this is, certainly a trend that will continue. And I think the final thing to say, just in terms of incumbents, when we listed 5 years ago and where we are today in the beginning of 24, is a very different attitude and approach to working collaboratively with fintechs, in particular B2B fintechs. These are relationships now that are well established. There are multiple proof points of technologies being used at scale, where they're being deployed to millions of customers on a global level. And I think the risk for many of these large incumbents is much lower than it was 4 or 5 years ago, where there was that concern of who am I getting into bed with? Can I trust their technology? And I think that has been a real cultural shift. So working, collaborating with many of these large incumbents now is a much more realistic and actually straightforward proposition than it was 5 years ago. So let me talk briefly on Augmentum in terms of what we've built over the last 5 years. And, you know, as I said, what's really important, I think, for investors over the next 5 to 10 years is to build that diversified exposure. And it's our job to really find those needles in a haystack, because there is a lot in the market. There is a lot of noise. There's a lot of hype, as I've said. And we really have to sift through those thousands of opportunities across the European fintech ecosystem to provide that diversified exposure by subsector areas where we believe, you know, one, we want exposure, and two, which present what we think are some of the most exciting opportunities over the coming years. And this has kind of really evolved over time. And I think what's important here is to recognize that, you know, this will move over time depending on the maturity of the relative companies in each of these segments. But these will kind of wax and wane as we, you know, see businesses kind of come and ultimately exit the portfolio. But as some propositions, and I think insurance is a really interesting area where we've had very we spent a significant amount of time looking at the market, but have been quite circumspect and nervous about the risk, in particular at some of the business to consumer propositions that we saw in the market. And there's been a huge amount of capital go into disrupting insurance, but we've not really seen to date a single unicorn exit in Europe. And that's really important, that I allude to what I mentioned earlier, be right, but don't be right too early. And we would expect markets such as that to now start to really break through as we see a real shift, in particular amongst the incumbent insurers that recognize the need to accelerate their digital transformation, but also to work with the very best in class B2B infrastructure players, in particular in the insurance space. And that's certainly an area where we are spending an increasing amount of time, and you know, would expect that segment of the pie chart to grow. So I can't talk about fintech or tech without talking about valuation. So James, maybe we can go to the next slide and just show you know, those watching what happened in that crazy period between second half of 2020 and the end of Q1 in 2022. And I think the criticism that has been leveled against many of the listed PE and venture players, in particular in the UK, which is why many of us suffer from a significant discount, has been that we haven't followed the listed markets in terms of kind of recalibrating valuations. And you can see here that high growth listed index at the peak of the market, which on this chart was in March 21, traded at an unprecedented forward revenue multiple, so just under 24 times. I think if you look at this over an extended 20-year period, you're looking at that long-term average to be somewhere between 6 and 8. I think the frustration we've had has been when we look at Augmentum's valuation approach over that period, and you can see the purple line here, when you look at our top 10, which currently accounts for around 80% of the NAV, even at the height of the market, our forward revenue multiple didn't really move. So when the question comes, why haven't you written down your valuations by 60–70% to reflect what happened in the public markets, the argument back is, well, we never wrote them up. And I think that's a really important point to make. And you can see where we are now, you know, hovering still at a discount to that listed fintech index. And if you look at the growth rate of this listed fintech index, so in particular over what has been a very difficult period economically over the past 12 to 18 months, you're seeing the range of growth here somewhere between -10 and positive 15%, whereas the Augmentum top 10 has grown over the past 12 months north of 70% as well. So these are businesses that are growing faster, yet are being you know, priced at a discount to the listed market, which frankly has been growing at a far slower rate than that. So I hope that gives investors comfort that we're taking a prudent and reasonable and realistic approach to valuation, and it's about pricing for today rather than hoping for what's coming down the pipe tomorrow. And just jumping to 11 briefly to give you a sense of the what we think is a great value opportunity. This just really gives you a snapshot of where we are today, where you look at the market cap, you strip out the cash on the balance sheet, which gives you your implied portfolio value today of about 144 million. We've got 24 assets in the portfolio. If you look at our top 5, they're valued at north of the implied portfolio value. So in accrued terms, you're getting the other 19 assets for free and a slight discount on the top 5. So it really does present a compelling opportunity for both investors who've been following us and following the space for a while to say, is this the right time to come in? And we certainly think that the portfolio is really worthy of consideration in terms of how it's matured and, of course, the track record that we have built over the past few years. So I'll just wrap up on 12 very quickly, just to give you, a sense of what about that top 5. So if you were only investing in that top 5, looking at that discount just on them, these are businesses that you can see how they've grown since we've invested in them. You can see how the NAV is as a percentage of the overall business, but also north of 100% year-on-year revenue growth, and the forward revenue multiple is still sub 5 as well. So in our view, really compelling investment opportunities, in many cases still growing incredibly well, despite the fact that some of them are now profitable and established and on that path to exit over the next couple of years. But just because they move into that more mature bucket, it doesn't mean that that growth is slowing down. But ultimately, the objective for some of these businesses has been, can we turn down that growth dial and really demonstrate that these businesses can shift to profitability? And I think in Tide and Zopa and Bouillonville's case, that's absolutely been the case. We've got 3 businesses that have become profitable. And finally, on 13, ultimately the true test is, can you be delivering realizations? Can you be delivering cash back into the fund? Really important metric for us is that the 5 exits that we've had to date, all of them have been at a significant uplift to the holding value, to further kind of reinforce what we think is underpinned in the NAV as well. So that is really important. So of the sub in and around 200 million that we've invested over the last few years, we've already delivered 84 million back in realizations, and we would expect future realizations to be at the level that we hold it, or hopefully significantly above. And that 30% average uplift on the holding valuation, I think, is an important metric that we're proud of, and hopefully can continue to maintain that number over the years to come. So James, hopefully that's given a helpful accelerated pitch and also set the scene on what we're seeing in the market.
Yeah, that's great. So have you got the money in for cushion? Is that in the cash balance?
It is, yes. The money is in the bank.
So have you sort of told the market what the sort of plan is in terms of your capital allocation policy going forward? So do you have any kind of plan to return some money to shareholders from profits, or is it all going to be reinvested in new stuff, or you buy back shares? What's the plan with that?
So the long-term ambition has always been to make sure we can build the trust to scale. So when we listed, we're at 90 million. We sit here today just sub 300 million in NAV. So that has been kind of a really important factor in getting to this point. In our key terms, we do have a provision that up to 50% of any excess proceeds, i.e. profitability, can be returned to investors after shareholder consultation. And we've had that interaction with some of our key shareholders when we've exited the likes of Interactive Investor. And I think the response has been, what we really want you to be doing is getting bigger and reinvesting. I think the important thing is to make sure, one, we have a strong balance sheet, and currently we do. We have capital that we can put to work, not just in our portfolio, but into new opportunities as well. But I think the answer to the question, James, in a scenario where we would have that outsized return, which we certainly hope we would over time, if there is capital that you don't think you can put to work in a 12-month period, then certainly we would look to return that capital to shareholders as well, after consultation in as tax efficient a way as one can do. So I think that's kind of a really important premise. I think for us, we think there's significant scope to continue to grow the trust. We believe that the strategy can comfortably sustain, 400 or 500 million of NAV, but ultimately that has to go hand in hand with the underlying shareholders as well. And I think the power law and venture is that you should have 1, 2, or 3 outlier success stories over time that deliver that outsized return. And I think, hopefully, as and when we have that, then shareholders will benefit not just in NAV and share price growth, but also in seeing some of that return come back to them in time.
Okay, thank you. So you got 17% in cash there. Is that a normal level? Do you always like to have some cash in reserve? Would you ever take the fund to be geared, or?
We don't have any gearing in the trust. It's not something that we have on our priority list. We're longer cash than we would normally be. I think it's important in this market. Over the past 12 months, we have frankly sat on more cash than we would normally like to, but I think it's been really important to be patient in the market, to recognize that we went through a very unhealthy dynamic in 21 and much of 22 as well, and we were waiting for that market to normalize. And we are price sensitive, and we are not only looking for great businesses, but we're looking for great businesses that ultimately will turn into a great investment. And that doesn't always come hand in hand. We saw a lot of exciting businesses last year, but frankly, we felt the entry price was wrong, and we weren't being rewarded if we got it right for the risk that we were going to be taking. And I think, what we saw last year was a real flight to quality, where a lot of businesses weren't coming to market because they were concerned about the market and about valuations. And so we didn't feel the same level of quality was there in 2023. And when there was a high quality asset, that was being bid up quite aggressively from a pricing point of view. So I think from our side, it's to remain disciplined. We think 24 and 25 will be exceptional years because we do think valuations will continue to moderate. We also have seen a continual exit of the market from funds that were quite short-termist. They raised, they deployed, not particularly effectively, and frankly will struggle to raise any more capital. And also from strategics who were building their own venture funds, the largest corporate financial services businesses. A lot of these global banks were building their own in-house venture capital funds, and we're seeing many of them step away from that market because they recognize what they're very good at is frankly not backing early stage venture businesses, even if there's a strategic rationale for them to invest. So we think there is a lot of capital still in the market. We think differentiation and specialism is really important because that allows you to really kind of sift through the noise. We've had the best part of 20 years either building businesses or investing in businesses in the European tech ecosystem. So, we have a phenomenal network which we're leveraging, but we absolutely have to leverage all of our competitive advantages to ensure we're getting into the very best opportunities, because these compelling investment opportunities are competed on. There are a lot of good investors in the market, and being a generalist on a global level makes it very hard. And I think that's why that regional specialism really does allow us to have that differentiation and hopefully that competitive advantage in the market.
Can you say a little bit about what makes a sort of good new investment? And you mentioned about things being too expensive. How do you value stuff when it's that sort of embryonic?
Yeah, it's a very good question in terms of, I often talk to more established growth capital, private equity, who can't get their head around, valuation. And it isn't an exact science because you are backing very ambitious visions. And there is a lot of, jam for tomorrow. I think what's really important when you're coming in at the Series A is to make sure your structure is right as well. Yes, we're all hoping for a great outcome and to make 5, 6, 7, ultimately 10 times our money for the very kind of positive cases. But we do need to structure that downside as well. So we come in with a preferred share. So we sit at the top of the stack per se. So if a business is valued at 20 million, and we put 5 in, the post money is 25, we own 20%, the business doesn't end up working, but there's some strategic value, it gets bought for 5 million, we get all our money back because we sit at the top of the stack. So we have to protect that downside. So that allows you to have a little bit more flexibility in that entry valuation. We also would add, James, anti-dilution to the proposition. So in a situation where that business raised more money at a valuation of 10 million 2 years down the line, we were diluted below that headline price. We would then be issued more shares to compensate us for that. So there are some mechanisms that you can put in there with to protect your downside. But ultimately, there isn't a perfect science. What you often look at is, founders will come in and say, we want to raise 5 million, and I wouldn't want more than 20 or 25% dilution. And that almost gives you the implied price. Now we'll sit there and say, do we believe this is a business that has the characteristics that are required to deliver us over the long term a 10x return on our money in the outlier cases? And so what does that look like? I mean, yes, we're looking for an exceptional management team who are tackling a significant problem that the market is looking to be solved in the current environment. And the market opportunity is meaningful as well. And so more often than not, the latter two characteristics are ones that we see in most of these businesses. Financial services is a big market. The subsectors that people often target are very significant and is often a problem that we think needs to be solved. Where investors in the venture space get it wrong, and we've been guilty of that at times in the past, is we haven't picked the right team. It's been a big, ambitious proposition with a big market opportunity, but frankly, the execution hasn't matched the vision. And that is why we spend so much time and effort on really getting under the hood of, do we believe this is a team that can deliver on a hugely ambitious proposition, but is going to be exceptionally difficult to execute on over a long period of time. And, if I go back over the last 20 plus years of the winners and the losers, the ones where I've taken the most learnings from have been those ones where the proposition was sound, the opportunity set was right, but I just didn't get it right on the people that we backed. And I think that that never leaves you. That leaves a lot of scar tissue for you in terms of your learnings going forward. So we would really over-index on people and their capability.
Fair enough. Now you talked about investing in relatively early stage, sort of like the sort of Series A, Series B type area. Would you ever pick things up pre-IPO when they're sort of they're more established and look like it's going to be a winner?
Not really. I mean, that's not our focus. I mean, our job is to get in earlier. We will take risk when we get it right. As I said, we want to be rewarded for the risk we take, because all of our bets aren't always going to pay off, and we need to make sure we deliver over the long term that blended return of 20% compounded. That puts you in the top decile of investors. So we want to get in at that early stage where we're coming in at a price where we can get that outsized return. I mean, give you an example of, when we backed Interactive Investor many years ago, and we rolled that into the new fund, we bought 10% for £2 million at 20 million. That business sold for £1.5 billion. So, if we'd ridden that journey all the way through, that kind of crossed over from our old fund into our new fund, so we didn't kind of get the full benefit of that. But those are the types of kind of outlier returns that you're looking to find. When we built Betfair as entrepreneurs 20 plus years ago, the early investors in Betfair made something around 300-400 times their money. Now, maybe you only get one of those in a lifetime, but that was an extraordinary return for those investors that came in, and the risk that they took was exceptionally well rewarded. I think there might be cases where you look at towards the end of this maturity cycle where, never say never, there might be something so opportunistic There might be a distressed seller in the market where you have deep domain expertise and understanding about a particular sector, challenger bank. There's a stake on the table. You see a path to liquidity within 2 to 3 years. You have the structure with your closed-ended investment trust that allows you to kind of be IRR driven, not just multiple of money driven. But I would say those will be the exception rather than the rule. I think the opportunity for those investors looking at a fintech is for us to do the hard work. If I look at our CRM database, we have interacted with some 5,000 fintechs across Europe over the last decade. As such, we're tracking, a large number of them. We're building those relationships. There is pattern recognition in, in seeing the good and the bad. And I think we have to really kind of leverage that 2.5 decades of experience and also having as much, almost full coverage. You can never say you have full coverage of the whole market, but most of the market, and really kind of lend that learning expertise to those early stage businesses. But you're going on a journey with them. These are not overnight success stories, which is why you need a good, good sized portfolio, 25, 30 businesses in the portfolio to allow you to kind of, have some that don't quite work, to have a big enough pool of potential winners in there.
Yeah, that's fair enough. We see sort of the banks typing up here, sort of emerging towards the sort of price of productivity. Is that why they're the biggest chunk of the thing? Is it because they've been successful?
Yeah, and I think that the hype cycle, that's not just in our portfolio. Just we have got some assets in there that have been around a while and are really kind of breaking through. So I think there's definitely some truth to that for sure. But I think we've seen the early movers in fintech were in particular those B2C banking platforms that we saw a huge amount of money come into the challenger neobank space. And we've seen a number of ones that haven't worked and fallen by the wayside, didn't get to scale. And then you've seen the ones that really have got to scale. And it wouldn't surprise me over the next couple of years, we see the first kind of, IPOs, or more likely, in my view, large strategic transactions happening from incumbents that recognize that they missed an opportunity by perhaps not buying some of these businesses 2 or 3 years ago. They're a little cynical, and now they're seeing actually the value of not just the customer base that they built and the product set, but the technology and the cost that these businesses are operating out, the relative cost compared to some of the kind of traditional players who, frankly, per customer, operate a much higher cost base. They just cannot get those same efficiencies as a result of how their technology and infrastructure is built.
You talked about the anti-dilution protections and things like that, but how important is it to follow on investments when companies are asking for more money? The question here is asking about Volt and Grover.
Yeah, I think you want to be able to follow on up until a point where the businesses can stand on their own 2 feet, or they've got to that growth capital stage where you would have investors with bigger checks, exactly as you said, James, that come in that pre-IPO round. So you want to be able to defend your position in your winners for sure, but at the same time you can't kind of follow them all the way through, but you want to avoid dilution, certainly at the A, the B, and the C rounds. I think equally it's important to just be disciplined and not follow your money in businesses that aren't performing. I think that is the danger in venture, is you become emotionally attached to these businesses, and you might throw good money after bad, and it's important sometimes to kind of cut the ties. So the rule in venture: back your winners. That will absolutely maximize the return. If I give you a very painful example for that, I can give you Interactive Investor, where we own 10% of that business in our previous fund. In between IPO and the closing of our previous fund, i.e. when we'd invested, we didn't have that follow-on capital, and we diluted down from 10% to 3.5%, which ultimately cost us 80-90 million in lost upside, which was incredibly frustrating at the time. But it was just one of those things. And I think had we maintained that state, when we had deep conviction in that business, and we tried very hard to try and get an option post IPO to kind of roll in more of that. That would have been an even more phenomenal return than the 80+% IRR and 11 times our money. So I think we've learned the hard way over the last kind of 20 years of back your winners and the importance of the power law in venture. And I think we're really clear on both one, following in when it makes sense, but equally recognizing that it doesn't always make sense to follow on if a business isn't performing and you don't see a long-term future for that underlying company.
Obviously, rates have sort of peaked now. It looks like, and hopefully we're sort of entering a sort of more rosy backdrop for growth type companies. Are you kind of optimistic for 2024?
So I think it's I think I can be glass half full by saying that there is still a lot of money sitting on the sidelines, in particular amongst the kind of traditional GPLP structures. There's more dry powder than we've ever seen at any previous point in history, and investors are paid to invest. So I think there will be investment in the market at all stages. I think economically, it's hard to see a particularly buoyant year. I think we're seeing stabilization, obviously, in inflation. The expectation is that interest rates have peaked and we'll see them come down. How quickly remains to be seen. So I think from an economic point of view, it's going to be unpredictable. I think from an investment point of view, you will continue to see that flight to quality. I think from a sector point of view, as I've shown in some of the slides, there's a long way to go. And so structurally, over the next 4 to 5 years, there's huge numbers of opportunities where we think there can be some very significant businesses that will be built and are being built in the fintech space. I think the long-term trend, the macro for fintech is hugely exciting. I think the short-term macro economically and geopolitically is going to be challenging. But then we just look at that huge pile of dry powder, and we would expect that to start being deployed in a more impactful way at some point this year. Maybe not in the first half, but certainly towards the second half. So yeah, I think it's going to be a busy year. But I think for investors such as ourselves, it's continuing to be focused, disciplined, price sensitive, and hold your nerve to make sure we're getting into the right businesses at the right entry levels, and hopefully we'll be able to do that.
Great, thanks very much, Tim. That's been really instructive. So we will get you back on in a year or so and see how it's all been going. But thank you very much for today.
Thank you, James. Pleasure to be here.
So next week we're back talking to SDTL energy efficiency, and then we've got a few more lined up. We are conscious that we need to fill in the hopper, so we are inviting people as we speak. If there's anybody, as usual, if you particularly want to talk to, then do shout and we'll try and get them on. We can't always promise that they'll say yes, but most of them do. And so have a good week, and we will see you next Friday.